guys.
All right, Jared, thanks so much. Let's talk about all this and what to expect over the next couple of weeks. We want to bring in Barry Bannister. He's Stifel's chief equity strategist. And Barry, we have the S&P just shy of 4,200 today. You have a target on the S&P for 3,750 by the end of the fall. Why don't you think this upward momentum that we've seen in the market is going to stick around?
Well, when you think about it, the stock market's typically very strong from the 1st of November to the 30th of April. That's the seasonality effect. And there's some peculiar math in the way seasonality can be calculated. When you're coming off the bottom of the range, strong 6 divided by week 6, in other words, November, April relative to May, October, when you're coming off the bottom of the range over time, seasonality really reasserts itself very strongly. So we had a pretty strong November 1st to April 30th, it looks like, and it went to right where it was supposed to, 4,200, it looks like it's going to be. But it also argues that the summer of 2021 will be difficult. I think there's a number of factors, particularly I expect another pickup in yields that will weigh on some of the growth stocks. Some of our back half estimates are not as strong as these first half beats, and so the dissipation of the beat rate would affect sentiment. And global liquidity should slow down. That can be caused by China tightening, which they're doing, Europe hesitating on fiscal, which they're doing, and the U.S. Dollar perhaps strengthening a little bit, which weighs on global liquidity growth. So I think it's been a fun ride, and it's typically strong November to April, but it sometimes fades.
Barry, if we hear you correctly, sell in May, go away. When do you come back, though? Because you're talking about a 10% correction by the end of October. Do you buy on that dip?
Yeah, I mean, you tend to, it's not a perfect, obviously, indicator, but sometime between May and October, May 1st, October 31st, we'll see a 10% correction. So, 3,750, 3,800, depending on where the earnings estimates finally come in at, we could see that as downside risk. Every indication that we have, though, is that the gains will be reconsolidated into the summer. So you're going to find that the easy money has been made. And just like the summer of 20, where you had some volatility in the market, you would see the same thing happen again now.
Barry, you mentioned the fact that the pickup in yields is going to weigh on growth stocks. So where are you finding opportunity? Is it just in some of those value names?
Well, obviously, more reflation is a good thing for value. A steeper yield curve is a good thing for value. It's bad for growth, and the price to earnings ratio tends to fall. The multiple of the market tends to fall. And that's because growth is a long duration asset. The infinite duration, longest possible wait for cash flows is those companies that make no earnings. And they've been pretty strong in an era of negative real yields. This is 10-year treasuries after inflation. It's quoted as 10-year TIPS, TIPS, Treasury Inflation Protected Securities, the 10-year TIPS yield. That is minus 80 basis points. You're locked in at minus 80, according to the Treasury curve, as a basis point return for 10 years after inflation if you buy a Treasury today. So that's not a particularly attractive return, and it's pushed people into growth stocks with long duration, distant cash flows. A reversal of that, which we saw some signs of in first quarter, and typically the bond market comes in waves, sort of like COVID. It's not going to just be all at once, and that's all you're going to see. It's going to be another wave up in real yields as the world recovers, and all this fiscal coming out of Washington. Trillion is the new billion. Every day I wake up and there's another trillion plus spending proposal out of the Biden administration. This adds up, and it's an awful lot of stimulus in a short period of time, largely debt financed, so you can see how yields might rise.
Wait till you wake up Thursday morning and we get another proposal that's coming down the pike in the trillions very, very quickly. So going forward, though, if I hear you correctly, because lots of us are lazy investors, passive investors, but picking value stocks when you're a passive investor, that's not a possibility. How do you wake us up to act on what you've just shared?
I believe there are value indices. Vanguard has VTV. Don't hold me to it, but I believe it's IWG or something like that at BlackRock. They have a value index. So you can buy value and you can buy growth. And that's really been the story for decades. Okay. So in the 90s, you wanted to be overweight growth. In the O's, the Bush years, through early Obama, you wanted to be overweight value. And then from about the 2010 midterms to 2021, you wanted to be overweight growth. And our work shows that you're about to rotate back to being overweight value.
Barry Bannister, always great to have you on. Thanks so much for taking the time to join us today. Stifel's Chief Equity Strategist.